My name is Charles Brown III, aka CB3. I'm a portfolio manager and financial educator, and I've been an investor for more than 30 years. As a portfolio manager, it's my job to keep our clients calm during difficult market periods. I did it in the crash of 2008. I did it in 2009 and 10 as a commentator for Fox News. And I did it in 2018 during the trade war scare. But 2020 was different. The pandemic brought a new intensity of uncertainty to all of us. When I began researching this week's show, I asked, how can I encourage them financially this week? How can I help them make their week more successful? That's why CB3 Live exists. We've been on 2 platforms in 2 cities with the goal of providing financial truth and a sense of calm about what's happening right now. Every week, I look forward to providing financial peace of mind to my clients and listeners. It's for this reason that it's a privilege every single time I start a broadcast by saying, from COVID, U.S. policy, and world economics to clarity. This is CB3 Live. Good evening, everyone. Live from Nashville, it's Thursday, October 14th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are glad you're with us. Before we start, a happy birthday to my bride, Alice. Tomorrow, she'll be 39. I know, how did I manage to get this gorgeous young babe? Well, somehow it happened. Those of you that know her, feel free to wish her a happy birthday in the chat. Lot to talk about tonight. The Octoberflation story, of course, it's been growing all year long, and the autumn outlook. A lot of positive things that I'm seeing that the corporate media doesn't see, but we're going to set the record straight tonight. If you're new to the broadcast, please, on YouTube, subscribe to us, click the little bell so that you get updated whenever we post something. It's either going to be live or sometimes intra-week when I have a live update or sometimes not a live update. But anyway, we're uploading content on a fairly regular basis. And if you want to keep up with us, definitely click the bell. Subscribe to me or follow me, if you will, on Twitter. We're also on Facebook and YouTube. So the monthly review, we always start off looking at the previous month's unemployment report. That's why we've taken this to a monthly broadcast. We look back on last Friday when the unemployment report came out, said the job market is weakening. Now, I'm putting these comments in quotes because I don't think the job market's weakening. I think that's what's happening because of the supply of workers. I'm going to get into that extensively in the next few pages here. Non-farm payrolls only grew 194,000. They were expecting 500,000, but we're still growing. We're not shrinking. And remember, we're still pulling out of a pandemic. Job growth in September, slowest of the year. Okay, that's not so bad though, because September, just coming out of the summer, we're still revving up, getting full activity back in the economy. I do not see that as a problem. Whenever they announce non-farm payrolls for a given month, since we're in October, they're announcing it from September or for September. They go back and they revise August and July. Both of those revised upward. The unemployment rate at 4.8% is the lowest it has been in quite some time, and average hourly earnings jumped. So when you hear the corporate media say they're discouraged, ignore that. We're still seeing positive job growth. The Bureau of Labor Statistics surveyed showed 526,000. We don't actually use that data. We're using the survey of employers, and employers, of course, are not coming back saying, well, gosh, we think this is going to be a great time for job growth, because they simply can't find enough people to work. That's the challenge in our economy. If you look at the payrolls, look at the drop here, the enormous drop on the left-hand side when the pandemic began, because literally the government just shut down millions of businesses, and we're back to basically a minus $5 million people loss, all right, in jobs. That's a pretty amazing comeback, and if you need to see that in perspective, I'll show you that in just a few moments. So the change in employment is favorable in almost every industry, especially leisure and hospitality. Those, of course, were the hardest hit. And where you're seeing job losses in state and local government, frankly, I'm glad to see this. This is one of the most encouraging slides in the whole presentation. So we need less government, in my opinion. You know that I'm a fiscal conservative, like to be able to make a lot of our decisions locally and at the state level and not at the federal level. So I'm not minding that loss at all. The U3 unemployment rate, the survey was for 5.1, the actual 4.8. I mean, this is a plummeting jobs number. And this is where you want it. This is like golf. You want a low number for this particular score, this particular data piece. All right. And the reason for that is we want to see lower and lower unemployment. Unfortunately, one of the reasons why this number is low is because people are not going back to work because they're still sitting home and getting benefits, which is one of the reasons that the market has not responded super well. Although today you wouldn't know that because it was a phenomenal day. The fear and greed index, I don't show this that often, but right now our confluence of factors shows that there's still pretty significant fear in the market, and that's the top piece. If you look at the bottom piece, goes all the way back to 2019, and you can see we're approaching that ebb where fear is extreme. When fear is extreme, that means people are selling. When a lot of people are selling, eventually sellers stop. When there are no more sellers, you only have one thing, and that's buyers. And that's what happened today. Huge move, best up move since March. And that's because people, I think, are finally seeing the data. As those of you that have watched this program for the year and a half I've been doing it, I research data and I bring that to you. I'm a portfolio manager. I manage real money. Most of you on the call here are actual clients. If you're not, I hope that you'll be one in the future, or maybe you know someone that can use our services. But if you're just here for the education, I'm happy to do that too, because that's just part of what we do here at CB3 Financial. Now, this is a classic line, a must read in one of the, corporate media papers here, okay? Buy the dip is dead. In other words, it's gone, right? So buying the dip died when the volatility sellers failed to show up. So what's the reason? Well, here's the picture of the bear. Click there to continue reading. This is what you call clickbait. Okay, buying the dip has not stopped. Today was a perfect example of that. And the people writing these articles are either uninformed, dumb, or manipulative. And I think it's probably a combination of the three. The corporate media wants you to watch them and wants you to be filled with angst so that you keep tuning in so that you can find out more reasons to be discouraged about the future, and you'll just keep clicking and coming back to them. Don't do it, folks. I'm showing you the real data, like this piece. Look at the 2008 recession and recovery. All right, we're in the 134th month, if you will, of that, all the way back to 2008. Now, we have a much steeper blue line drop in the 2020 Great Lockdown and Recovery. I didn't name these. That's somebody else's job. But look at this enormous V-shaped recovery. I've been showing you that really since the first day of this program, that we are going to have a V-shaped recovery, and that has played out. All right. And you're seeing it here. Obviously, we're only in the 19th month of this, but it's already extended beyond where the previous dramatic sell-off, that 2008, played out. So I think this is well on target to pull out of this. One of the reasons we stay fully invested, look at the olive or whatever you want to call it, gold bar there. That's the fourth quarter. We're in the fourth quarter now. And historically, if you go all the way back for the Dow to 1896, that's how robust this data is. For the S&P, 1928, for the NASDAQ, 1971, and the Russell, 1986. The fourth quarter is historically, not traditionally, historically the strongest market performance quarter. Now, people have, every once in a while, I'll get someone that'll say, don't you think we should have a little more cash? Really? No, I don't. We're in a secular bull market. We're heading into the strongest quarter. If we were heading into the summer and it had this 5 or 6% pullback, would I have considered it? Perhaps. We're not even close to that. Not even close to that. We're in the fourth quarter, which traditionally has the strongest performance. Okay? Now, number of record closes. All right, guys. What do we have here? We've got 54 record highs set this year. That's more than 2020. That's more than every year but 1995. Where are these prognosticators getting their information saying we're heading toward a bear market, buying the dip is gone? 54 new highs. Have we had one in the last 3 weeks? No, we have not. Will we have one before the end of the year? I predict many of them. And I'll see you a couple more times to see if I was right. Okay? Number of pullbacks. People get scared when the market pulls back. All right? You see how many pullbacks we have there on an average from 1970? 7, 8. In 2007, we had 11. 1. Lean in on your monitor, folks. You see the little red one there? We've had 5% pullback, and that's happened since the last broadcast. It's just nothing to be concerned about, okay? Earnings projection. You guys that have been watching know that I show you this every time. The average number is a 73% beat on the S&P. See the yellow highlight there where it says above expectations? Right now we're at 76. Now normally, I say normally, over the last several quarters, that number has started higher. I wish that this had started a little bit higher. We're only about 5% done on the reporting for the third quarter earnings. Remember, we're in the fourth quarter, so S&P is reporting on the third quarter earnings. But I'm not discouraged. We've got a lot of headwinds out there. A lot of them are psychological headwinds. Some of them are supply chain headwinds. Some of them are COVID headwinds. And yet the market continues to exceed. Again, 76% of the S&P is above what they were projecting for earnings. Those of you who've been watching for some time know this chart. Now, I'm going to leave this here for a few moments because this is important. And those of you that are new to the chart, I'm actually going to pause here. You guys just take this in. Let me check the chat here. All right. Hey, Hossein, good to see you. Andre, good to see you. Haven't seen you in a while. Blah, blah. Let's see. Everybody. Okay. Thank you for wishing Alice a happy birthday. All right. This is a 100-year chart of the S&P 500. The red areas are secular bear markets, and the blue lines and the descriptions there, the returns, are secular bull markets. We are in the third secular bull market in the last century. The previous two lasted more than 20 years. This one started April 10th, 2013. And if you look, I know it's tiny. What you can do is do a screenshot on this and then look at it later, or I'll send you the chart if you want it. But look at the returns. These are the 11 sectors, okay? XLK is technology. XLC is communications. XLY is discretionary spending. The aggressive sectors have all dwarfed the performance of the S&P 500, which is in yellow. Still not a bad return, 179%, okay, since April 10th, 2013. But the aggressive sectors, far, far better. So people say, well, why aren't you buying consumer staples? Why aren't you buying Procter & Gamble? We do buy more conservative stocks in GI, which is our growth and income program. But in our aggressive growth programs, it's just not going to be in there. Because, again, the data says that the aggressive sectors are where you want to be if you're in a growth program. If you want a copy of this chart on a full screen, I'm happy to send it to you, okay? So sit back and think about all the fundamental, and remember, fundamental to me means funny mental, because people will say we're making our decisions on fundamental data when I think it's really just kind of funny mental. You know, they're just kind of psyching themselves out, because the actual technical data, which is how I trade and invest for our clients, is very different than what some of this funny mental is. Remember, these were all supposed to take down U.S. equities over the past decade. TARP, remember TARP in the Obama administration, Troubled Asset Relief Program? Quantitative easing, inflation, government debt, the rising dollar, faltering GDP, the Fed and higher interest rates, the Fed and lower interest rates, 100-year pandemic, trade wars, various elections, deflation, Donald Trump, Donald Trump's hair. All of these crazy reasons are supposed to take down the market. The list goes on and on and on, blah, 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 blah. It's just not going to take down the market, folks. We're in a secular bull market. And if you want more explanation on what that is and why that is, go back to previous videos. Follow the charts. Don't follow the hysterical medium. This is our returns. I put it up here on the screen every day. Our benchmark for our programs, for the two growth programs, is the S&P 500. 3-year returns I've highlighted here. Capital growth, if you were with us for 3 years, you're beating the S&P by 190 basis points. Over 5 years, 250 basis points. Diversified growth and growth in income are more benchmarked to the Vanguard balance, so it's just a more conservative approach. We do have clients in all 4 programs. Obviously, I am in all 4 programs, or I, Alice, and our family trust is, because for those of you that are new, we don't invest in anything that our clients don't invest in. So we invest in our accounts and we mirror those trades, obviously in discrete accounts, for our clients. So our clients know that when they look in their program, or they look in their portfolio at Interactive Brokers, which is our clearing firm, and they see certain holdings, they know that I'm holding them. And if they're going up, I'm going up. They're going down, I'm going down. I have a lot of skin in the game, maybe all of it, okay? Because that's what we believe is the fair way to do this for someone who is managing money. You have to understand what's in there and why it is. And we want your customers to understand that too. Check in the chat box. My rehearsal during this time. Okay. But we're glad you're here, Andre. So any questions on this? I can send you this. I'm happy to talk about performance. This is audited. These are from statements at Interactive Brokers. Happy to give you more information if you want it. So I tweet, and one of my recent tweets is, why do I think inflation is transitory? The key point is that the bond market itself is devoted to the proposition that this inflation is a blip caused by the pandemic and will be over in a matter of months. If bonds were scared, bonds would be much more volatile, and they are not. Which is bigger, the bond market or the stock market? You don't have to answer, but I'll just tell you, the bond market, much, much larger market than the stock market in trillions of dollars. The bond market is not behaving like it thinks inflation is going to be a serious problem. Bonds do not like inflation. Why? Because they have a fixed rate of return. I'll be talking about bonds quite a bit as the program progresses. So looking at the world economy, basically the first portion of this program, I'm reviewing what caused us to get to the performance that we've had so far this year, 1 year, 3 years, 5 years. What I'm doing from the world economy forward is looking at what could either make things better or worse. Now, this is subjective. Obviously, these are my beliefs, but I share them with you because I want you to know how I'm managing your money, how I'm managing our money, and why I think that the secular bull market continues to be strong. But you may come to a different conclusion. That's fine. Everything that I'm showing you has been sourced from multiple locations. So inflation, could that be a problem? It's certainly worth a discussion, and that's what we're going to have right now. Most people surveyed, and this is a global fund manager survey, these are not the folks down the street, think that inflation is going to be transitory. That moved up just a little bit, and the number that think it's going to be permanent dropped just a little bit as of the most recent survey. I don't make my decisions based on what other people are doing, but I do note that I am walking in sync with this group, certainly since they're global fund managers. So where do you expect inflation to be? I'm in the second bar there. I think we're going to be between 2 and 2.9. Realize that 3%, which is the one underneath that, 3 to 3.9, is an acceptable number. At least it was to the Fed until a few years ago when they set 2% as their target inflation level. So we can do just fine in this economy with a 3 to even 3.2. If we get up to 4, that's going to be an issue. But the number of people predicting 4% or higher, less than 10% in the last quarter, about 11% this previous quarter. So I just don't see it as an issue. I don't see it yet. And that said, how many S&P 500 companies are mentioning inflation in their earnings calls? Well, a high here for since 2018. Again, these are quarterly earnings calls. This is when companies come out and say what they think they're going to do, and then they actually present their earnings sometime later. They're mentioning this to cover themselves. They want to cover their tracks. All right. But not enough to concern me, and this is the most important chart on inflation. The 2-year U.S. inflation rate change. See the bump in 1980. Most of the people on this call tonight were alive in 1980, and remember the Carter administration. Ronald Reagan comes into office, and he's got to face an 18% inflation rate and has to beat that down, which happened over the next few years. The point of this is not Reagan or Carter. The point is, that extreme level of inflation has not been seen in 4 decades. and it's not going to be seen this time. Look at the chart. Again, recency bias. If you're new to the show, you haven't heard me say this. Those of you that have been on here for a while know that I talk about recency bias. That's the proclivity, word of the day, proclivity of the human mind to focus on what's happening right now. And that's all that I can see. No, it's not. Look at the data. All right. Look at the data. And when I look at that chart, I go, wow, okay, well, I guess I was kind of freaking out about nothing because, it's really just kind of in line with how it's been the last 20 years. That's the truth. That's the data on the chart. Turn off the TV. Okay. Consumer price index and producer price index are the two components that make up the analysis of inflation. And inflation is not uniform. I've said this on previous shows. Wouldn't it be great if we could have like 5% inflation, maybe 6, 7 on our houses and 1% on all the other cost of goods that we buy? That would be great. If you find a way to do that, you could probably sell that in a formula and be a gazillionaire. Okay. So inflation affects different assets differently. I'm going to show you that on the chart here. Consumer price index, you see the spike, this blue line, the heavy blue line. Yes. Is it high? Yes. Okay. So go back to 2009, the last time this happened. Did it stay up this high for more than a few months or certainly more than 1 year? It did not. So is there a chart that goes way back? Yeah, the Great Depression, where inflation was that bad, even then for only 2.5 to 3 years. We're nowhere near that kind of economic environment. Just not an issue. Changes in consumer prices, as I said, it affects different parts of the economy. So what's the highest inflation right now? Heating fuel. And why is that? Well, maybe it's because the minute the current administration came into office, they shut down the pipelines. They became hostile to fossil fuels. We're finding that we have to go over to OPEC and ask them to ship us more oil when we had it here all along. So if you're concerned about inflation with heating oil, maybe you should just find your least favorite piece of furniture, throw it on the fire, and use that. But other than that, are you seeing anything? We're looking at 1% here, household furnishing, new vehicles, food at home, etc. Now, a big deflation on airline fares. So when all of these average out, that's how you come up with the consumer price index. So it doesn't affect everybody's inflation rate in America is slightly different because we consume different products. Makes sense? You might not have thought of that. But what your inflation rate is and what mine is not necessarily the same. Where there is a little more uniformity is in the producer price index. This is business. These are people that are producing widgets and doing whatever. The number that just came out yesterday in red here, core PPI, less than a 0.2% annualized growth or increase. I shouldn't say growth, okay? Consensus 0.2, significantly below the consensus of 0.5. You might say that's 0.3%. But when you're talking about billions of widgets at a huge scale with an economy that's $25 trillion, that is a big difference between 0.5 and 0.2. And again, this is like golf. In this case, you want a low score. 0.2, much better than 0.5. All right, chain reaction. So what is happening here? Supply chain bottlenecks. It's the biggest thing in the news. I have a son who is in the logistics industry, sending each other graphics every day, just boat after boat. Offshore, Los Angeles, Long Beach, Savannah, New York, can't get these boats unloaded. Got a client who sells trucks and can't find enough drivers. I mean, our real issue is supply chain here. We've never in my lifetime, and I've looked back 70 years, not 100, seen a situation where we've had such dire employment challenges in a thriving economy, and it's because we can't find enough workers. So this supply chain bottleneck is a much easier fix, okay, than unemployment. All right, than a recession or a depression. Much easier fix. Eventually, supply will catch up. It will. So, in summary on inflation, what you see on the left is what the corporate media is doing. This is me on the right going, inflation? Okay, I get it. But they're just looking at it differently. Why? So they can sell you entertainment. Okay, don't listen. I'm giving you the data. I do it every month. I want you to be confident that until I see something significantly change, we're investing to be fully invested in this secular bull market. And this market has shown me enough times, certainly since 2013, since the low really of March 9th, 2009, 676.53 of the S&P, for instance. That's how long ago that was. And we're over 4,000 now. This number is just not an issue. If you are concerned, and many of you on the phone here, running on the call, I should say, are recipients of Social Security, the biggest bump since 1982 will happen in January. That's actually going to affect Alice and me as well. So we'll get a little bump in our check. We're happy for that. But that's what happens. Social Security is not a static number. It does react. Now look here on the chart. You can see in 16, 17, and 10, there was no inflation because it was a terrible recession. So there was no increase in payments. Okay. So inflation data is rivaling non-farm payrolls. So I spent as much time on inflation tonight, and I really need to start tapering this off because I think I've given you enough conclusive data that you really shouldn't be concerned. And if you are, then just contact me privately. Okay. I'm going to still mention inflation, but I spent a ton of time on it, as almost as much, maybe more, than I did on non-farm payrolls, which is a more important data number. The debate is transitory versus persistent. It's on the screen. In my opinion, inflation is certainly not on an unstoppable increase. I just don't believe it. Before I start on COVID, let me look in the chat. Well, never thought the stock market would be larger than the on bone meal. That's good. Doc, yeah. The stock market would be bigger than the bond market. Okay, now I figured it out. All right, still waiting on a cassette player. Well, yeah. Some of you know, I'm a composer, and I had to wait on, they ran out of manuscript paper. I can't even print parts for the woodwind quintet here at Vanderbilt University's playing my woodwind piece. And so all kinds of supplies are just not getting into the retail outlets simply because they don't have enough people to unload the ships. And it's going to get better, guys. I promise you it's going to get better. Just curiosity wise, the bond market is much bigger than the stock market. The currency market is much, much bigger than the bond market. So not everything is all about stock. So in COVID, guys, I would love to stop talking about this, but I called the high in mid-September. It remains the high. We had this bump with the Delta variant. It's tapered off. The death rate also significantly tapered off. And I've said this every time I mention these data. I don't mean to minimalize if you know someone that you've lost or was very ill. I have friends that contracted Delta and the Delta variant and that didn't get it the first time around. And it was really scary for them. And I feel for them. But I guess the good news here, whether you believe the vaccine works or not, the vaccine percentage of America is approaching 60%. This is full vaccination. And I think that's one of the reasons that the amount of cases is dropping. At least that's what I'm seeing from the CDC and Johns Hopkins. I trust Johns Hopkins more than the CDC, just for a reference here. So what does this mean? People are saying, am I going to be comfortable traveling? Well, that has ramped up. That's the dark blue line. From December 20th, it hit a peak in June, and then it's tapered off again because of the strength of the Delta variant. And then the others that'll say, well, in 6 months or more, that's dropping off. So what that means is they're stepping up and saying, you know what, I think I'm ready to go out and participate. When you watch sports on TV, I don't know if you guys watch college football or the baseball games, but it's jamming. Here we are in the South, in the Southeastern Conference. These football stadiums look as full as they were 3 years ago. So I do see that people are coming back and, some of them wear masks, some of them don't. So how many people are staying out of the workforce because of COVID? In May of last year, 10 million or more Americans. Now it's just 1.5 million who state the main reason that they're not coming back to work is because of COVID. The real reason they're not coming back to work is because Uncle Sam is paying them and enabling them to be deadbeats. Now, it's a strong word, and I've used it before, but the reality is it does not help when the federal government, and now they're talking about $1.5, $2 trillion, $3.5 trillion in infrastructure. Well, that's not roads and buildings they're talking about, folks. They're talking about social infrastructure. We'll talk more about that in the political section, starting right now. All right, what is the U.S. debt ceiling? I know you guys have been following this. Congress imposed this. If you don't raise the debt ceiling, so why do we even have to raise the debt ceiling? Well, because it will not come as a shock to you. Both Republican and Democrats, more Republican administrations than Democrat administrations have had this issue where they spend too much. No. Yeah, they spend too much. All right. And so they have to go crawling back to Congress and say, we need you to raise the debt ceiling because we can't meet all our obligations. And you know what happens if we don't meet our obligations. Okay. So then the two parties go at it. So on Tuesday, they voted on party lines. What a shock. All right. That they're going to extend. They're kicking the can down the road. That's right. Looking down, kick with your foot. Bam, move that can 2 months down the road, or more like 6 weeks. Democrat lawmakers wrestling to try to get this, set up. They wanted a permanent increase. Mitch McConnell's not going to allow it to happen. So now they've kicked the can down until December. Nancy Pelosi floated the idea of we're just going to give the Treasury Secretary the power to raise the borrowing limit. Well, I know that this will come as a shock to Nancy, but you don't have the power to do that, even as Speaker of the House. Okay, that's something that it would have to be an amendment in the Constitution. Holy cow. All right, so this is from Bloomberg. This is pretty cool. So in case you're worried, well, what happens if the debt does default? Well, first of all, it probably won't. And if it does, we'll see. But what happens if the government shuts down? Well, I gathered this data actually from a screenshot on a recent Bloomberg broadcast. So 3 days, S&P up 2%. 5 days in 1995, up 1.8%. Between 2018, 2019, 35 days. That's the longest shutdown we've ever had, up 13%. Why? Because Wall Street, always looking ahead, is saying, this isn't going to continue. Why? Because their political lives are at stake. Because the people coming in to challenge them on both sides of the aisles are going to say, you remember that debt shutdown? We need to boot this person because they couldn't come to terms and raise the limit when they needed to. All right. I have snarkiness alert here, guys. I have a client who sends me these and I never put them in. So I decided I was going to put them in this time. He sent me this snapshot of an electric car charging station powered by a diesel generator. Now, I know there are people on this broadcast tonight that are very pro green energy, and there are some that are very pro fossil fuels. I think there's room for both. But I just found these hysterical. Here's a tow truck towing a diesel generator, which is now charging an electric car in the middle of the highway. Folks, if you can't laugh at that, then I don't know what to tell you. But the reality is to just think that this current administration thinks everything's got to be green, got to get rid of fossil, not gonna happen anytime soon. It is ridiculous to think that we can just do away with fossil fuels and the entire infrastructure behind them. Okay, that's my 2 cents here on the political front. Economic indicators, I show you these because these could swing either way and affect what I report to you next month. Okay, I quoted this last time. I may keep quoting this because it's so appropriate. And then Jesus, he said to his disciples, the harvest is plentiful, but the laborers are few. Therefore, pray earnestly to the Lord of the harvest to send out laborers into his harvest. Well, you may or may not be a praying person. I hope you are. If you are, then this is a great prayer to pray. We don't need people necessarily to harvest soybeans and wheat and corn out in Nebraska, Kansas, and Iowa. We need people to show up and respond to job openings. That's the issue that we have right now. The supply chain is bogged down because there aren't enough laborers to deliver the widgets that the manufacturers are making. There aren't even enough people in the factories. Why? Look at it in red above there. There are now 5 job openings for every unemployed American. And you hear these calls of, we're going to have a recession, we're going to have a depression. How can that possibly be? If you go back to 1920, there were 8 people applying for every job. Look at me on camera here. There were 8 people applying for every job. in the Great Depression. No wonder we had a depression. You can't feed your family if you're 1 through 7 and the 8th one gets the job and you have to just keep looking and looking. And in the meantime, the bills pile up and nobody's eating. We have 5 job openings for 4 unemployed Americans. We've never had a situation like this. Never. Okay, this is people not wanting to work. This is job postings. It goes back just a year or so. If you start at the 0 point, we're up 45% in the number of job postings that are going unfilled. That's an enormous gain from the low of May 2020. Okay, so that would be the nadir, the low of the COVID scare. Up 45%, job postings not getting filled. Share of small businesses with positions that they're not able to fill. Guys, this goes back to 1973. Look at the scale at the bottom. 1973, we're at 52% of small businesses in America that simply can't fill jobs. This is crazy. It's crazy. You cannot have a recession when there are this many businesses that are making money, that are exceeding what their earnings projections are. You saw that in the previous chart. They're having to work their current people to death, literally, because they just need more laborers. That's not a recipe to start a recession. So the mismatch in the labor market is upending this usual relationship between unemployment and job openings. Normally, as unemployment rises, job openings fall, but it's just the opposite right now. It's happening. They're both rising at the same time. Here's one of the reasons. Our cars take chips. Did you realize 1,400 semiconductors control everything, all these different functions on our car? And if all these cars need semiconductors, Alice just bought one of those little devices that cleans. You ever seen these things? Well, our cat jumped on it, and so he's got the little remote control and all these little processors in there, and he's having such a good time with it. He asked if he could take it to the skateboard park. I mean, everything that you buy, from a vacuum cleaner to a car, has chips in it, and we can't get enough of them. We can't get the silicon. We can't get the people to ship it. We can't unload the barges when they're out in the ocean. There are not enough people to do that. And then you've got to ship them from LA, New York, Savannah, to wherever in the country you need them. This will get fixed. But until it does, we're going to have a supply shortage. I suggest you shop early for Christmas, folks. What does this mean, though? Equities are at a record percent high of household net worth. When I see this, I'm going, there's no way. There's no way we're heading for a recession. People are buying equities. They're getting wealthier. Look at the chart. It goes back to 1952. 1952, 40% of our household net worth is in equities. And you see the light blue line, that's real estate. So there's less and less real estate. Doesn't mean that real estate is being sold off. It just means that equities have increased so much that they've taken over there. Household balance sheets, that's your net worth. Assets minus liabilities equals net worth. Has never been stronger. Look at the blue line at the edge of the page there, going back to 1950. We're coming out of a pandemic. We had a recession last year. Granted, it was only 9 weeks. All right, how is this happening? It's happening because of an incredibly resilient market. What does this mean? It means that U.S. household net worth, look at the red line, 140 trillion. This is in billions of dollars. 140 trillion dollars. Lifetime high. Nothing even comes close. How are we doing this in a time when the pandemic is still ruling? We have political chaos. We have gridlock in Washington. How is this happening? Because that's the strength of the market. The Fed. What's the biggest challenge for the Fed right now? Well, is Jay Powell going to keep his job? I've been talking about this for 2 months. I thought we would have known by now, but Joe Biden has not said anything about whether he's going to continue to let Jay Powell be the chairman. He has to reappoint him, and Congress would have to vote on it. I hope that he does. I think Powell has done a pretty good job. I have not always been a friend of Jay Powell's policies. Certainly I was not during the Trump administration, but given a more left-wing, far left person that could take the job, I will take Jay Powell any day. His statement is that the current inflation spike is really a consequence of supply constraints, exactly what I've said, meeting very strong demand, meaning supply and demand are not so this is what it looks like on a rubber band. If you have demand, supply has to move and go over and meet it, okay? If it doesn't, it just stays here, and this rubber band gets tighter and tighter and tighter, and you know what that's like if it snaps. It's not going to snap, but that's what's happening in the economy right now, okay? It has a beginning, middle, and end, he says, and I do think we're probably in the middle of it. I think you're going to see supply catch up probably after the Christmas season, though. The Fed funds rate has been unbelievably low for the last 10 years. There is a projection now, and look at this. I know you look at this line, this brown line, and say, oh no, interest rates going up, okay? But look at the scale on the left-hand side, all right? They're talking about in September of 23, 2 years from now, a 50 basis point rate. What's the average Fed funds rate? Okay, which is what the interest rate that kind of drives everything that happens in America? It's 3.5, 3.75. And so they're kind of tiptoeing and saying 0.5. Guys, that's not inflation. It's just not. I'm giving you the data. Come back and watch it again. There's nothing to be concerned about. In crypto, all right, I know some of you really like this section. I have an equal number of people that say, I want more crypto. I want more crypto. And I say, you know what? Don't do this. Just get it done with in 2 or 3 minutes. The truth is, folks, I have to talk about what's out there. And tonight I'm focusing on the apolitical nature of Bitcoin. Bitcoin is an asset class, and as you'll see in a few minutes, it's had a pretty strong return since it just is a very new asset class. I mean, think how long it took for stocks and bonds to really get traction. Not happening with Bitcoin. In 2011, right? So we're looking at 10 years, 2009, pardon me. So 12 years. All right. So apolitical. I did not know this till I ran the data and got this from CoinDesk. 45% of the owners of cryptocurrencies are on the left, 52 on the right, 3% are independents. So it's pretty evenly split. It's an apolitical asset class. Now, the government trying to ban Bitcoin, I had my artist do this for me. It's like putting a gate on this little road and a little sign that says, do not walk here. And of course, the person just walks around and looks at the sun and the beautiful, it's too big. It's like saying, let's put something up in the sky to stop it from raining. It's about that crazy, all right? It's not going to happen. The government, no government, certainly not China. It was a joke. It just was a joke. Why is this? Because a majority of countries in the world are looking at their own digital currency. Once again, the governments of these countries, including ours, are behind the 8 ball when it comes to innovation. Digital currencies are here to stay. Whether they're going to be completely free market like they are now in the crypto space, and don't just think that it's Bitcoin and Ethereum and Litecoin. There are thousands of them that are itty bitty. The big ones you know about that I just mentioned, okay? But you're going to continue to see digital currency development because governments want to control. That's what governments do. As a citizen of the United States, I don't want the government controlling anything of mine that I don't give it permission to do. Well, the government pretty much just takes its own mind and decides what they're going to control. And I don't like that. That's one of the attractions to me of Bitcoin. Folks will say to me, so what is it like comparing Bitcoin to gold? Isn't Bitcoin just an alternative to gold? Well, look at I'm not going to read this, but just look at the difference. And the only one you really need to focus on is the last one. Gold has an unknown amount of supply. You can mine gold until there's no more. Well, there's no indication yet that we've run out of gold. But there is a finite supply of Bitcoin. There's a finite supply of almost all the cryptocurrencies. What does that mean? It means that they can't make more of it. If you have a finite supply, then by nature, you can't have inflation on that because you can't just print more. That's the problem in this country and every country where they can just print money. What's the intrinsic value of the US dollar? Well, dollar bills are printed, distributed by the government, and backed by nothing. That's right, nothing. Nothing at all. It's just paper. And it's not just the US dollar, it's the euro, it's the pound, used to be the lira, the Australian dollar, okay? The Venezuelan whatever. If it's worth I don't know, one is like 300 thousandths of a penny or something. That's serious inflation. Why? Because they keep printing it. If you know that you have an asset and you think that it's a rare asset, and all of a sudden tons and tons of it are discovered, what does that do to your asset? It drops it. It drops it in value. If you have an asset that has finite worth, then you know that it's going to hold relatively stable or increase as the population and the demand increases. Okay. So I haven't shown this in a while, but I have talked about how I invest in cryptos. I continue to state to you that if you want to do that, I don't do that for people. I don't manage. This is not a sales pitch. At some point we might, because I've had enough people ask. But I just wanted you to see the percentage I have in Bitcoin, Ethereum. Do a screenshot on this. You're welcome to do it. Polkadot, Uniswap. I have pulled back on the amount of what we call alternative coins, and I have 70% of my net worth in this account in Bitcoin and Ethereum. This is my actual account from Kraken, which is one of the best exchanges, at least for me, that they are. And I still believe maximum 5%. Okay. There are some asset managers out there that are saying, oh, you need to put 20, 25% of your liquid net worth in crypto. That is crazy. No, 5%. And I follow my own advice. Okay. So, all right. U.S. housing market, still strong data here, although it tapered off a little bit the last few months. Why? Is it because people are less interested in buying homes? Is it because the demand is walking away? No, it's because there's nobody putting their house on the market. It's the same issue with a different flavor that we're having with workers. People are staying in their homes and going, you know what? I like it here. I'm just going to improve my home, and that's just the way it's going to be. And so not enough inventories on the market. So what's happening? Look at the private construction spending. Now, non-residential in blue, which is basically businesses. What a shock. In 2020, it's flat. See the blue line down there if it's flat? And that's because nobody's investing. I shouldn't say nobody, but very many less, I shouldn't say very few, are investing in huge commercial office buildings. Because we still don't know what the aftermath. Are we going to become a Zoom society? Is it going to be blended? Is it going to be hybrid? Or is everybody just going to get in their car and get back out on the highway and go to work? I do not believe that for a minute. And I've been telling you that for more than a year. But residential spending, off the charts. Going back to 2006, nothing even close to that past data. Pending home sales, also very, very strong. Very strong. Down from the middle of 2020. Again, because you can't have a pending home sale if you don't have inventory. All right. Now you would think with this many people borrowing money and falling all over themselves to outbid the next person, that there would be some foreclosure on loans because people were buying, like in 2006 and 7 and 8, they were what they called liar loans or fool loans, where you would take a 100% loan and after the interest rates went back up, you were upside down and you just walked away from it. You would think that frenzy, because there's so few properties, would be infecting the buying market now. But look at this. Foreclosure at a percentage of loans, the lowest in 20 years. Folks, that is a solid real estate market. And it's not just in the South. It's not just in suburban America. It's all over America, and that's a great sign of strength for the economy. And what are the alternatives? Look at this rent chart, regular rent inflation, just straight up, and it's going to stay that way because people that either can't afford or can't find a property to buy have to rent. Unless, of course, you're in San Francisco and you can just live on the street for free, but I digress. All right? You have to rent. You have to have some place to live. And rents are very, very strong. Good time to be a landlord. I would not invest in rental property for anything because, again, I believe this is transitory. All right. New segment. Let's see if I'm missing anything over in the chat box. Good to know. Dr. J, thanks for speaking up. So here, wholeheartedly agree. Appreciate that, Andre. That's because they're using all those computer chips in the vaccines. Well, they're using them for a lot of things, and they don't have enough raw materials. They don't have enough raw materials to make the chip demand, and I just think they just missed it. They really just missed it. They meaning industry. You're seeing Apple cut back on iPhone expectations, right? iPhone 13, they're cutting production. Not because the demand's not there, because they don't want to say you're going to get it in 10 days and it's 3 months or longer. Okay? They'd rather say we're ceasing production than angering customers. So from time to time, people ask me, clients, people that watch the show, what about asset allocation? Talk about stocks and bonds. We've always heard you need a portfolio with 60% stocks, 40% bonds. That's hogwash. And okay, well, if it's hogwash, then tell us why you say that. All right. Right now, I have 4 asset classes that I love. 4. Okay. And they're here on the chart. You see the little bars there? Those are called candlesticks. That's stocks. Behind that is a Bitcoin. Behind that, or in front of that, is a house, and that is not commercial, but residential real estate, and then lots of dollars. All right. So those are my 4 lovable asset classes, and everything that I have, and this is just me. You don't have to agree with this. I'm just telling you what I do, and we've done okay. But that doesn't mean it's what you want to do. But I will tell you, but this is how we manage money for those of you that are clients. So it's probably pretty important to hear this. We have a blend, Alice and I, of stocks, crypto, real estate, and cash. If I love these assets, that must imply that I do not love. And so these are the unloved assets: art, real estate investment trusts, commodities, bonds, oil. And I do know very well what has happened in the oil market. All right. I understand. I do not think we're going to see $100 oil by next summer. And Bloomberg made that prediction today. We might. Again, the Biden administration could help that. If they just continue their same policies, we could see $120 oil. But what we really need to do is get our oil fields back up to maximum, get the pipelines going, so we're not dependent or even having to go over to OPEC and say, could you make a little more oil for us? Would you mind? Please? That's just dumb. We were energy independent just a few years ago. We need to go back to that point. But it's not an asset class that I want to deal with. So I do want to talk about bonds, right? Many of you are aware of James Bond and the latest in the series, which is in the movies right now. Alice and I went last week, and it was a lot of fun. You might want to do it. So I just took that and extrapolated that and said, instead of no time to die, no time to buy bonds. Okay. Why is it no time to buy bonds? And yeah, this is Heidi Steiner, my graphic artist. She's so clever. Got the Statue of Liberty there with the bonds. Okay. No time to buy. All right. Why is that? Okay. Here's your 10-year return. Global Bond Index Fund. Look at those returns. Now, you saw the chart, I don't know how many ago, like 42 slides ago, right? Where the 100-year returns of the stock market were. 179%. You remember the technology. 449%, I think. Since the bull market, the secular bull, started on April 10th, 2013. If you need clarification on why that happened, go back and watch previous episodes. I talk about why that's the secular bull breakout day. Okay, look at these returns. Why would you want to do that? I mean, really, why would you want to do it? Let's look at the comparison now between stocks and bonds. Stocks returns in green, bonds in amber or brown, whatever you want to call that. And you might say, well, oh, look at those down years, 1930, 1938, 2009, 1973. Okay, that's 90 years, 90. And I got 4 ugly bars there. And I've got some down ones, yeah. 4? Really? And you want to invest in an asset class? First of all, it's at almost lifetime highs. That's why the yields are so low in bonds. All right? 1.5% on a 10-year. If inflation's at 3% and your bond's at 1.5%, you're locking in a 200 basis point, roughly, loss every year. And it's got an opportunity cost as well. All right. So stocks over a lifetime, you say, well, I just don't want to take this much risk. Okay. Well, then have a smaller amount in stocks. All right. And we'll talk in the last episode of this in December about what I think that mix should be, or at least what we do. All right. But this is why I don't like bonds. All right. It just has been an underperforming asset class. This is not pro Bitcoin, but just look at the difference between Bitcoin and the S&P 500. So people that say, well, but if I had all my money there, I'd be a gazillionaire. Yeah, you would. But you probably would have had to have 3 different cardiologists by now and might not even still be alive because of the intensity of that asset class. But is it true that if you invested $100 versus $100,000 in the S&P, you would have had about the same return? Yeah. So that's why I say 5%, maybe not an unreasonable number. Could this blow up? It could. If you have 5% or 3% of your net worth in it, is it going to affect you? No. Is it an asset class that you need to at least deal with? Yeah, it is. Is it a better possible return? I'm going backwards now. Than this? Yes. Yes, it is. Not even close. Yeah. So this tip of the hat to bonds, sorry guys, not me. Bond yields have been nothing but a joke in recent years. Since the pandemic, their yields have collapsed even further. Here's the thing. You hear about negative yields. Those are bonds that are not paying 1 or 2 or 3%. They're paying -1. How can you pay -1? Because the yield is inverted. So if the price is high, let me say this again. With bonds, and I've told you guys this before, when the price is high, the yield is low. Yields move inversely from the price. So when bonds go down, their yield goes up. Now, if you want mechanics on that, there are episodes on my YouTube channel where you can see how that works. But in Europe, the prices of bonds have gotten so high that you put in $100,000 and you get back 99.5 or 99.200. And you would say, why would anybody do that? Well, because if their mandate is in their investment platform or their strategy, that they have to have a certain amount in bonds, they've got to pick the ones that cause the least damage, even though they're a negative return. Isn't that crazy? Now, Jay Powell has said we're not going to have negative yields on U.S. Treasury bonds. I'm not going to have it. Even the Democrats, even Janet Yellen agrees with that. So I don't see that happening here, but it's just not an asset class that I think is attractive. Ray Dalio, the largest hedge fund manager in America, said, look, the yields are ridiculously low. Even yields on cash are negative after inflation, and that's true. So when I said I like cash, I do. I don't have a ton of it, but I have enough that if the market has a significant sell-off, I'm not going to go into my investments and pull money from it. I'm going to use the cash that I have. We're going to talk about that. You need to tune back in November and December, okay? So nominal bond yields just off the lowest ever made. You might note if you got a house, we bought this house here in Nashville. Our interest rate is 2 5/8. Oh, why didn't you pay cash? Why in the world would I have paid cash for this house when I can borrow money at 2 5/8? For those of you that weren't bond traders, 2.625. Okay. The return in our programs last year, those of you who are clients know this, 63.5. Even this year, 18 something, whatever you saw on the charts earlier. Yeah, I know we're down a little bit from last year, but you can't have a 63% to return every year. The point I'm making is that if you can borrow money at 2 5/8, 2.625, you ought to think about doing it. All right. That's another strategy we'll talk about as this series moves forward. So these are the 10 richest people in America. Actually, the 10 richest people in the world, because there's one here that's in France. I can tell you without any reservation that none of these men, and they're all men, got rich investing in bonds. None of them. They're either self-made, some of them inherited wealth, but most of them self-made, and they did it with equity. Sorry about that. But the reason that they're able to do this is because money compounds. When you're producing widgets, when you invest in the market, these are equities. You're investing in something with the expectation of a return, a significant return. And you have enough reserves in case that return does not play out so that it doesn't affect your lifestyle or cash flow. We'll talk about that as we go forward, okay? But that is why bonds are an unloved asset class. We do not want to miss out on any part of the secular bull market because we're trying to time the bond market. That investment strategy simply makes no sense. And that's my word on bonds. Guys, that's our show. If you got questions, type them in. I don't see anything over there now, but I'll give you a few minutes. These are what we covered tonight. World economy, didn't have a featured stock, monthly review, economic. These are our normal topics for those of you that are new that we cover every month. If you have questions that either you didn't feel like typing in tonight or maybe you think of it later, I'm CB3 at cb3.com. That's how you can find us. The next live show is November 11th, usual time slot. Notice that it's Central Standard Time for the next show, okay? Encouraging you to tell your friends, your family, if they are interested in the markets, whether or not they're looking for a money manager. We're trying to present the most honest and encouraging data we can, because I have nothing to gain by selling you histrionic drama that the corporate media, and by the corporate media, I mean CNBC, CNN, CBS, NBC, that are the prognosticators. There we go. Second word of the day. Prognosticators of gloom. I've even renamed Bloomberg, Gloomberg. All right. And you've heard me say that before, because they make money selling you drama. If you want drama, watch FBI. That's one of Alice's favorite shows. Tons of drama, wall to wall. But when you're talking about finances, you're talking about the market and investing, drama is not good. It's not healthy. That's not in your best interest. I always sum up my show by saying this from 2 Timothy. We have not been given a spirit of fear, but a spirit of power and love and a sound mind. Let me look in the chat here. Are you currently in any mega caps? Hey, Ken, how are you? We are. We have some of the FANGs. Well, certainly Microsoft, Apple. Apple's a perennial hold. NVIDIA, so I don't know what you call a mega cap. I mean, there not that many stocks have $1 trillion market cap, although do you realize that Apple at one point was $2.7 trillion? That puts it like, the 14th largest company in the country in the world. So if you want to see the holdings, I'm happy to show you guys the holdings. They change from time to time. Obviously, I'm an active portfolio manager, but I have no problems sharing that if it's something that you want to see. Okay. That's our show for tonight. Glad that you were here. Glad that you are part of the audience at CB3 Live. We love doing this for you. We love managing money. If you have someone that you know that could benefit, please tell them to come to our channel, to click the little bell, get the updates, and we'll just continue to do this and hope if you've got questions, CB3 at cb3.com. Happy to help you. I am Charles Brown with CB3 Financial here in Nashville, where we don't just manage your assets, we become one of them. Good night, everyone.